It looks like we got some people joining here, so thank you for joining us for the first CORA Capital that we're having of 2025. Today we have Jack Manley from JP Morgan, which is timely, talking about the economy, the markets. I've seen some volatility in the last few weeks, so it's definitely a great presentation to keep us focused on what's important. Jack is an executive director and a global market strategist with JP Morgan. He is responsible for delivering timely market and economic commentary to institutional and retail clients across the United States and Canada. In addition, he's a contributor to the JP Morgan Long-Term Capital Market Assumptions and has authored numerous papers on both global and domestic economies and capital markets. Jack is also a frequent guest on BNN, Bloomberg, CNBC, and Fox Business, and is often quoted in the financial press. He graduated from the University of Chicago with a bachelor's degree in history. So Jack, thank you for joining us. Appreciate your time today. As I mentioned, it's a very timely presentation, so feel free to get it started.
All right. Well, thank you very much, Justin, and I appreciate you making it through that bio. We got to get you an updated one. I trimmed out like half the commentary there to still be compliant, but definitely a little bit more tight. Thank you, everybody, for taking some time to dial in. There is very clearly, Justin, as you said, right, like not a shortage of stuff to talk about. I always think that with calls like this, my purpose is not to dust off the crystal ball and gaze into the future and tell you exactly what's coming down the pipeline. What I'm going to try to do over the next 20-25 minutes is just help us to see present conditions with a little bit more clarity, to sort of isolate the signal from all this noise that's out there and really hone in on those things that are going to matter most to markets. And that ultimately is where we're trying to get, right? Having a view on markets, on stocks and bonds and portfolio construction and risks and opportunities and where to go right now. But if you want to have that view on markets, I think there are a couple of other things that need to happen before, sort of a foundation for that view on portfolio construction. I would say, for example, that if you want to have a view on markets, you have to have a view on interest rates. And when I say interest rates, I mean in particular, at least right now, the Federal Reserve and monetary policy, right? Interest rates are the cost of money, and the cost of money matters a lot. It matters for the economy, it matters for stocks, it matters for bonds. It may be the single most important variable that you can have a view on if you want to figure out how to invest. But if you want to have that view on interest rates, on the cost of money, you have to understand what's going on with the economy. Because when the Federal Reserve gets together, and it'll actually be getting together in a little under a week at this point, it has a press conference, it issues a statement, maybe it does something with interest rates. It's doing all of these things in response to underlying macroeconomic variables. The Fed is going to sort of implicitly pay attention to growth and recession risk, of course, but the Fed explicitly, per its dual mandate with Congress, pays attention to things like employment and inflation. And so we need to pay attention to those things too if we want to have that view on rates, which again is foundational for having that view on markets. Now, that's the rough framework for how I think about things. I think it's a helpful way to approach investing. It doesn't matter if I have 5 minutes or an hour to talk about it. It's generally speaking how I tee things up. It's also the agenda for today's call, right? I'll be spending a few minutes up front going over what's going on with the U.S. economy. And by the way, when we talk about the U.S. economy, I do think it is helpful to figure out how things are going kind of steady state, and then how policy may influence these different areas. Then transition to what all of that means for interest rates, and then land on how to invest accordingly. And in that spirit, if we turn to the next page here, we can kick things off by taking stock of what's going on with U.S. growth. And we have a fourth quarter 2024 GDP print under our belt as of a few weeks ago. We won't be getting a first quarter GDP print for probably another month, maybe even a little bit longer than that. But so far, there seems to be a lot of evidence that there is a lot of momentum in the US economy. 2023 was a stellar year for economic growth, well above trend. 2024 was another very strong year for economic growth, modestly above trend. These were 2 years of back-to-back economic activity that were quite good, and perhaps even more expectedly, or more importantly, unexpected. Right, a lot of people in 2023 thought the economy was heading into a recession. A lot of those same people in 2024 thought the same thing. This recession never actually materialized. This economy has been remarkably resilient. And if you are trying to figure out where this unexpected resilience came from, which I think, by the way, is worth doing, because if you figure out where it comes from, it's easier to figure out if it's repeatable, if it's durable this year. This page does a good job of helping to at least tease out a bit of that answer. And you look at the table on the top right side of this page, it looks at how the different components of the economy drive GDP, and you will see that consumption is the engine of growth in this economy, accounting for almost 70% of all GDP. But even more interesting is the chart itself, which looks at real GDP growth, real economic growth going back 4 years on a quarterly basis. And you will see that quarter in, quarter out, the only bar here that is consistently positive, consistently additive, is that light blue bar is consumption. In other words, consumption is not just the biggest part of this economy, it is also the most stable, most dependent part of this economy. And so figuring out where the economy is going from here, I think requires us to figure out where consumption is going from here. And where is consumption going, right? Why has the consumer been so unexpectedly resilient? Well, the one thing that I think we can always point to here is the labor market and how supportive the US labor market has been for consumption. Now, just last week, we got the latest employment report. It showed, once again, very strong job gains. It showed, once again, an unemployment rate floating near all-time lows. It showed, once again, very strong wage growth. All of this important for our ability to go out and spend. You're dealing with all these problems. We're all dealing with all these problems: higher prices, higher interest rates, geopolitical uncertainty, domestic policy uncertainty. And yet most Americans that want jobs have them. And they have the confidence, or they did for a while, that they're not going to be losing those jobs anytime soon. So you feel comfortable swiping the credit card today because you know a paycheck's going to come in the next couple of weeks. And so if we're trying to figure out where the economy is going in 2025, we have to figure out where labor is going in 2025. And that's where the next page comes in. There is still quite a bit of demand for labor in this country. In fact, if you look at the number of job openings out there, we are still modestly above where we were pre-pandemic. So lots of job openings out there. The problem that we are facing is not on the demand side of labor, at least not right now. It's on the supply side of labor, right? It's not just the demand for jobs, it's the bodies to fill those seats. Look at the chart on the top right side of this page. It breaks down population growth in this country. And what you would see, if you could kind of double click in and just look at the last few years, just look at the growth of the labor force itself, what you would be able to see is that the largest driver of labor supply in this country last year, the year before it, the year before that, and the year before that was immigration. Legal immigration, for what it's worth, right? These are people that are moving here on visas and working in our industries. And immigration has become such a big part of labor supply growth because our own domestic demographics are working against us. You got an aging population with the baby boom rolling out of the workforce. You have a birth rate that continues to decline. Americans just aren't having kids anymore, at least not at the rate that they used to. And if you look at that chart again on the top right side of this page, you will see that within about 10 years, the Census Bureau is projecting that our domestic population, births minus deaths, is actually going to start to contract. It is awfully hard to grow an economy with a shrinking population. And so immigration has been this kind of Band-Aid to help to fix things. Now, when we think about policy that's out there, right? Immigration policy has not been front and center recently, but we do know it is one of the pillars of this administration, right? Changes to immigration policy. And while we don't know exactly what this immigration policy will look like over the course of this year or this term, we can be reasonably confident that any change to immigration policy will likely result in less of it, not more of it. And so the single largest driver of labor supply over these last few years, it may be handicapped to some extent. And what that means, if job demand stays elevated, but job supply becomes depressed, we might actually end up seeing an even tighter labor market, a lower unemployment rate, stronger wage growth. All of this, I would say, supportive of continued consumption, supportive of a strong consumer, supportive of a strong economy. You add on top of that things like tax cuts or deregulation. You have a number of forces out there that are acting as turbochargers for an already pretty warm economy. But then the complicating factor, right, is the uncertainty that exists around policy. We don't know exactly what immigration policy is going to look like. We don't know exactly what regulatory policy is going to look like. And we certainly don't know, right now at least, what tariff policy is going to look like, trade policy is going to look like. And when every day you wake up to a new headline that contradicts the headline from the day before it, it gets awfully hard to plan. And so confidence decreases for consumers. It's harder for us to spend because we don't know what's coming down the pipeline. It's harder for businesses to invest because they don't know what's coming down the pipeline. Uncertainty around things like tariffs is worse than the tariffs themselves. And we are in a profoundly uncertain environment. So from a growth perspective, I see an outlook that is almost feast or famine. If everything kind of goes according to plan, we may be looking at a warm economy warmed further this year. Forget about avoiding recession. We actually grow again above trend. But things could also go sideways very quickly. And this stronger than expected economy could contract and end in recession. And in fact, the probabilities of that have been creeping up day in, day out over the past several weeks. So that's the growth outlook, right? Complicated. We look at the next page here. The other macro force that, of course, we got to discuss is inflation. Another complicated a macro variable, and one that is worth understanding kind of steady state before you try to plug in potential policy change. Now, this chart looks at inflation in this country as measured by headline CPI and shows you how over time the forces driving inflation have changed a lot. Right, look at the sort of high watermark on this page, right? 9.1% for June of 2022. That 9.1%, it's the strongest inflation has been in about 40 years. It's been a long time since inflation was that high. But think about what was going on around the world in June of 2022. Russia had just invaded Ukraine, two large producers and exporters of commodity products, food and fuel. We don't know how we're getting a hold of this stuff. We're still dealing with knock-on effects from COVID. China is still trying to stamp out the virus, right? Their manufacturing output is hamstrung. The ports of Long Beach and Los Angeles clogged up. Billions of dollars of cargo floating out in the Pacific Ocean, not enough longshoremen to offload the boats, not enough truck drivers to drive the cargo inland, right? These are the issues that we're dealing with in 2022. They are supply chain oriented. And if you look at that June 2022 print, you would see that more than half of it comes from just three things: energy, groceries, and goods. Now, since things peaked about 2.5 years ago at this point, the inflationary environment's changed a whole lot. We went from 9.1% to, as of yesterday, 2.8%. And alongside that compression in inflation, again, the forces have shifted. Energy barely registers anymore. Core goods barely register. Groceries barely register. These aren't the things that are driving inflation. What's driving inflation now, and has been driving inflation for about 18 months at this point, is evidently stickier. It's harder to come by. It's things like shelter costs in dark blue and spending on dining, recreation, other services. I like to sort of call that just fun in light blue. And when you think about these two buckets, I don't think the prognosis is particularly encouraging. There still aren't enough homes out there. Mortgage rates are still too high, making home ownership increasingly difficult and giving landlords more and more power to raise rent on their constituents. And when you think about what's going on with the consumer, when you think about the general confidence that's out there, when you think about how the wealthiest people in this country are doing better than they ever have, more and more money flows into fund more and more spending, more and more inflation. I think even in the absence of policy change, we are looking at 3% inflation being the new 2% inflation. In other words, we're not getting back down to where we were pre COVID, I think, anytime soon. And then policy comes in and shakes up this outlook. Tax cuts, those would likely be inflationary. Deregulation could be inflationary. Changing up the labor force and tightening it up could be inflationary. Tariffs, almost certainly inflationary. And so in this feast environment, right, where all these different policy changes are turbocharging US growth and looking for, potentially another year of above trend activity, they may also be turbocharging inflation, where 3% is the baseline, maybe it's closer to 3.5. But just as with the economy, there is a feast and famine outlook, with inflation, there is a feast and famine outlook. Because if all these policy changes end up tipping the economy into a recession, recessions are deflationary, not inflationary. So again, right, a complicated outlook. My base case here is a warming economy, warming growth, tighter labor market, warming inflation, but I could be completely wrong. All this could move sideways or go south, and all of a sudden we are in a recession. It makes, if we move to the next page here, having a view on interest rates extremely difficult. And that's what we've been grappling with over these past few months, trying to figure out what's going to happen with interest rates. Now, on the right-hand side of this slide, we show you two things. One of them in dark blue is what the Fed itself told us it was going to do back in December of last year. The Fed does this thing that almost every other central bank on earth does not do, which is they publish forward guidance. They tell us on a quarterly basis what they think is going to happen with interest rates this year, next year, the year after that, and over the long run. And we're due for one. In fact, next week at their March meeting, we'll be getting the first quarter summary of economic projection forecasts. So this blue line is going to change pretty soon, but at least for right now, this is our anchor. It's our benchmark. And back in December, after the election, after the Fed knew what government was going to look like and what policy changes were likely going to be, the Fed told us to expect, after 100 basis points of cuts last year, another 50 basis points this year, 50 the year after that, and 25 in 2027. But the other thing we show on the right-hand side of this page is the green line. And the green line represents what the market thinks is actually going to happen. And whereas that blue line only changes once a quarter, the green line changes every second of every day based off every headline and every data point. At the start of this year, the market thought the Fed was crazy. The market was saying, you're not going to cut 50 basis points this year. You're only going to cut by 2025. And you're not going to cut any more next year or the year after that. You're going to be done after that one cut. But as the economic outlook has gotten more muddled, thanks to volatility in policy announcements, the market's view on interest rates has shifted considerably. Now the market's worried. And it's saying we were wrong about 25 basis points. It's probably going to be closer to 75. And we were wrong about you being done this year. You're probably going to keep on cutting at least into 2026. That shift in that green line is the volatility that we've been experiencing over these past few months. And volatility in interest rates translates into volatility in markets. Unfortunately, I don't think we're out of the woods just yet. Because as long as those two lines do not touch, and as long as there is space between them, that space gets filled with more rate volatility. So as I look out over the course of this year, maybe the economy grows above trend, maybe it enters a recession. Maybe we see inflation warm up, maybe we end up seeing disinflation or deflation. Maybe interest rates stay somewhat steady, maybe they move lower. A lot of questions that nobody has the answers to right now. A profoundly uncertain time where there's a lot of volatility that should be expected. So how do you approach a market? Well, I think you want to be taking risk in portfolios right now, especially if you believe, as I do, that this economy will avoid a recession this year. But you have to account for all of that uncertainty by being cautious in your risk taking, if that makes sense. I know it sounds paradoxical, but you want to be a cautious risk taker right now. And that view, I think, can be reflected across both stocks and bonds. If you look at the next page here and have a conversation about fixed income, the way that I would approach fixed income investing is to, first of all, buy the debt of higher quality companies. There's actually nothing really wrong with the high yield market right now. It used to be called the junk market. That's probably an unfair way to think about this thing. High yield actually looks as good as it has in a very long time. But high yield will not perform during a recession. And if the economy does go under this year for one reason or another, you're going to want to own the debt of a company that's not going to go under with the economy, the debt of a company that's going to be able to pay you back. You want a higher quality allocation as part of that cautious risk taking this year. You also, I think, want to remove as much sensitivity or exposure to interest rates as possible. Because after the election, rates shot up by about 100 basis points. In the last few months, they've been halved by about 50 basis points. We don't know where rates are going from here. No one knows where rates are going from here. And if you start at the top of the right-hand side of this page, which looks at how different changes in the interest rate environment impact different parts of the bond market, you can see that as you move lower, these tail risks get bigger and bigger. I'm not putting all my money into 30-year treasuries right now because if rates move against me, I lose in a big way. So when I'm thinking about cautious risk taking in the bond market, some of that means higher quality assets, but it also means shorter duration assets, less exposure to interest rate volatility, all the while clipping a coupon that's better than it's been in 20 years. Now, if you look at the next page here, the other side of the investing conversation is the stock market. And of course, that has been in the news recently. If I look at my phone right now, the S&P is off about 1% today after having a fairly decent day yesterday, after having a couple very horrible days over the past couple of weeks. There's been a lot of downward pressure on the stock market, a lot of it having to do with this downshift in sentiment that I talked about earlier. The market hates the volatility around policy. They hate that today tariffs are 20% and tomorrow they may be 50%, and the day after that they may be 0%, and the day after that they may be kicked out by a month. Market does not like that kind of uncertainty, and we're being punished right now for it in the form of a pretty significant sell-off, a correction in the Nasdaq, close to a correction in the Dow and the S&P. But we have to acknowledge, right, that if we do believe in this story, that through all the noise, the economy will continue to grow this year, then I think we can be reasonably optimistic about the equity market in 2025. The trick is to remember something very, very basic, which is that over the long run, prices are going to follow earnings. You're not going to buy a company unless at some point it's going to make you money. Now, for a very long time, including recently, over these past few weeks, the Magnificent Seven has dominated markets, right? You can see that it drove more than half the returns in 2023, more than half the returns in 2024. And the Mag 7 is actually down this year while the rest of the index seems to be up. The Mag 7 is what's moved everything because the Mag 7 was the only game in town. But if you look at the chart on the top right side of this page, which looks at earnings per share growth for the S&P 500, you will see that in 2025, just to the left of that vertical dotted line, analysts are calling for the best year for earnings growth for those laggards, the S&P 493, I like to call them, the S&P 500 minus the Mag 7, in about half a decade. And as you move to the right-hand side of this page and look at quarterly earnings per share growth, you can see that as we get towards the end of this year, these bars are getting closer and closer. The Mag 7 is not the only game in town anymore. In fact, we are fishing in a much bigger pond. The opportunity set has gotten so much bigger, but there are added complications associated with that. Because with all this uncertainty out there, with policy, with macro, with rates, we can be reasonably confident that there are still going to be big winners and big losers this year. The general environment for profitability is more supportive than it was a couple of years ago. Rates are lower, inflation's lower, wage growth is lower now than it was back then. But how much lower are they going? And may some of these indicators actually start to tick up higher? Buying the index is not going to cut it in 2025. And so if you want to stay constructive on large cap US equities, which I think you should if you're being a cautious risk taker, then the way you express that caution is by broadening out your horizon, assessing a wider opportunity set, casting that wider net, and embracing active management. And now, Brittany, if we can move forward 2 pages, please. I'll close things out before we open things for questions. I just spent about 25 minutes or so going over my high-level views for what I think might happen this year with growth, with employment, with inflation, with policy change, with interest rates, and where the risks and opportunities may be in stocks and bonds. But I told you right up front, this call is not about wiping off the crystal ball and gazing into the future. I don't know anything that I just told you with any sort of certainty. And in effect, everything I've shared has kind of been a guess. I mean, they're guesses that I stand by, right? They're guesses that come backed up with a lot of research and a lot of charts, but it's a guess nonetheless. This page looks at asset class returns going back 15 years across stocks, bonds, US, international, large, small, high quality, low quality, a little bit of everything on this page. And what should jump off to you is that in any given year, it's really hard to predict the winners or the losers, because in any year, it's really hard to predict that next big source of volatility. It wasn't that long ago that we weren't talking about a global pandemic. Wasn't that long ago we weren't talking about a war in Europe or a regional banking crisis or large language models and ChatGPT or a war in the Middle East or DeepSeek in China AI. I mean, stuff happens really quickly and makes these outlooks irrelevant. And so instead of trying to predict that next big source of volatility, you got to do the next best thing, which is prepare for it. And there's no better way to do that than by diversifying, owning a little bit of all this stuff that we just talked about, and maybe more, and putting together an asset allocation portfolio. The problem here, though, I would say, is that it's oftentimes easier said than done to be an asset allocator, because asset allocation is not cool. You'll see on this page, it's never at the top of the dog pile. You'll never be the best performer in a year as an asset allocator. And in this world where we have so much instant gratification at our fingertips, a lot of investors just want to shoot the moon, swing for the fences, get rich quick. Why own bonds when I can just own stocks? Why own value when I can just own growth? Why own Europe when I can just own the US? Why own any of this stuff when I can just buy Bitcoin? But we are not day traders. We are not chasing performance. We are long-term investors looking for long-term investing success. And if that is the mindset, then we got to remind ourselves every once in a while that the journey is oftentimes just as important as the destination. And diversification is that thing that's going to get you there safe. I'd like to thank you all very much for the time. I hope this was reasonably helpful given everything that we're trying to digest right now. And Justin, with that, I will pass things back to you to see if we have any questions in the last few minutes of the call.
Yeah, Jack, thank you very much. Appreciate all the wonderful insight you had there and all the charts and graphs and data. Very helpful. So thank you.
You're welcome.
One quick question, actually, I'll get it started. And for anyone that's online attending here, at the bottom of the screen, there's a little Q&A question mark. So if you do have a question, please feel free to type it in. And then we can see them on our end and we'll obviously get them answered for you. But just the question I had was around JP Morgan's targets for 2025 in terms of like maybe expected economic growth, market returns. I guess the first question is, what are they? And then the follow-up to that is, have they come down significantly over the last couple of weeks?
So it's a great question, Justin, that I am not fully equipped to answer. There are a lot of different parts of JP Morgan, and these different parts of JP Morgan will have different forecasts. Our investment bank, for example, will put out a target on the S&P 500. Our asset management arm through our portfolio management teams will put out targets on the S&P 500. My team actually does not publish price targets on the S&P 500. So I don't have any insight into what we think is going to happen. Almost everything in the guide to the markets is is based off of estimates that we bring in from external factors or external sources rather. So that chart that we looked at, for example, that looked at earnings per share growth for the S&P 500, those were not JP Morgan estimates. Those were actually estimates from Standard and Poor's S&P itself. We don't try to put any of our own projections in here. We let the sort of external pros address that question. So the first one, I can't tell you what the target is. To the second point, though, I would say that sentiment around here has definitely shifted down. It doesn't matter who you're talking to. People are less optimistic about the trajectory of growth this year than they were even a few weeks ago. But I have yet to meet anybody that is calling for a recession as of yet. So we are still looking for a good year for growth. And if there's a good year for growth, that should be a good year for stocks. And I think that optimism is still very much there. But I can say again that sentiment has soured at least a little bit on the backs of a lot of this policy uncertainty, in particular around trade.
Great. Thank you. So a question came in. What do you think about investing in dividend growth stocks versus bond funds for 2025, 2026? So I'm assuming it's going to be like dividend growers.
Yeah. Well,
versus fixed income, generally speaking.
I think 4 years ago would have been a no-brainer to invest in dividend growth stocks when bonds didn't yield you anything. Nowadays, bonds actually do yield you something, and what they're yielding beats out inflation. It's very hard to argue with 5.5% out of a high quality investment grade fixed income instrument. The problem with owning bonds is that if the economy does end up warming up, right, relative to where we are right now, which is a distinct possibility, interest rates are going to rise, and that bond that you hold is going to become less valuable. The coupon will help you out, but the price of the bond will go down, and so your total return may not be particularly encouraging. Meanwhile, in an environment where the economy is doing very, very well, those dividend growth stocks are going to be doing even better, right? Not only are you going to get the dividend, but the company is going to be doing well and the economy is going to be doing well. So the stock price should go up and you have both things working in your favor. On the flip side, if you are worried about the economy, dividend growth stocks are not the same kind of insurance policy as good old fashioned high quality fixed income is. So if you think we're heading into a recession, you're really worried about where the economy is right now, or even if you're not really worried, but you still want the insurance policy, I would advocate, looking to fixed income this year, high quality fixed income, as opposed to dividend growth stocks. So it really depends on your view on where things are going right now, how nervous or confident you are, and how you want to express those views. But again, fixed income looks awfully good from a coupon perspective, and it can provide protection. But if the economy does really, really well this year, it's not going to be a good place to be. Dividend growth stocks will be a better place to be. So just something to assess when we're kind of figuring out how things are moving this year.
Great, thanks.
Sure.
Question I have is with regard to, and there was a great chart that you had up earlier about the components of GDP and where it's come from over time.
Sure.
My understanding is that the government share of GDP from government spending has increased, significantly over the last couple of years, in the form of deficit spending, like a higher deficit spend than we would normally do as a country. With let's say the government spending cuts that we're in the middle of right now, is there any estimates as to how those cuts are going to impact overall GDP? And I know that's the $30 trillion question of, are we going to have a recession this year? Or are we not going to have a recession this year? But it looks like, to your point, the economy looks healthy, corporate earnings look strong. If there's a recession, all bets are off. But what we do know is going down already to some degree is the government spending piece of it. So if you can just speak on that a little bit.
Yes, certainly. So I'll kind of do this in a slightly different order. We're actually in the second quarter guide to the markets, which will be launching on April 1st, rejiggering a little bit of how we think about GDP growth. So in the slide that you had referenced, Justin, that I was using earlier, and Brittany's got it pulled up here, government spending accounts for 19% of overall GDP. What we're going to be doing in the second quarter guide to the markets is breaking out that government spending into federal government spending and state and local government spending. And interestingly enough, state and local government spending makes up the majority of government spending. 11% is in state and local government spending. About 7 to 8% is in federal government spending. So kind of interesting, right? When we're thinking about these cuts that are being made by the Department of Governmental Efficiency, it's not against the 19%. It's about a number that's closer to 7%. Not that it can't move the needle, it certainly can. But I think the scale is just a little bit smaller. The other thing I'm doing literally as we speak is I'm pulling up not this chart, but another version of this chart from December 31st, 2018. That's how long we've been publishing the guide to the markets. It's actually this is its 21st year, and I'm able to pull up old versions of these pages. So as of December 31st, 2018, which would be like 6-7 years ago at this point, 6.5 years ago, the government spending accounted for 17% of GDP. Nowadays, because this is an average that we have on this page, nowadays, if you'll bear with me, I will pull up the most recent daily guide to the markets and just take a look at that myself. Let's see. So we went from just over 17% to the most recent read being about 19%. So like a 2 percentage point increase is not, again, insignificant, but it is not, a doubling in terms of the contribution, the contribution to overall economic activity. These numbers here are actually fairly static. They move by a percentage point, half percentage point here and there. Now, when we're talking about a percent of $30 trillion, like it's a lot of money, but it's not, again, like a doubling. Now, how changes to government spending might impact the economy, it would likely be, modestly detractive from economic growth. What you would hope, though, is that if indeed we do wrangle in government spending, and we certainly need to wrangle in government spending and right size our deficit, if we're able to do that, rates may actually move lower, especially on the long end. Borrowing costs as a result will move lower, and it'll be easier to borrow and easier to spend, which is good for business fixed investment. It's good for consumption. It's good for the housing market. So any sort of hit to government spending may be made up for in an increase in spending across consumption or business investment. Difficult to quantify, but I do think putting those sort of guardrails around the conversation and just kind of fleshing out how it may happen is
yeah, and what we've been talking about with clients is that's where the impact of tax policy really matters, right? So if there's a detraction of government spend, consumer spending could possibly pick up if, in fact, we do get some more money back in our pockets.
Exactly right.
2 more questions here. We'll get through them real quick, because I know we're a little bit over time here. Do you see companies now investing in America versus outside the U.S., and will tariffs help the decision to invest in the U.S.?
I mean, that is the idea. I would say certainly. I mean, that is the whole point of tariffs, is to get businesses to invest in the States. The problem is, at least from where I see it, there are certain things that we just can't really do. A great example of this is when we think about energy markets. The U.S. is entirely energy independent. We produce more energy than we consume. But it is more than just crude oil pumping that you need to pay attention to. For example, you do not fuel your car up with crude oil. You fill your car up with gasoline, and gasoline does not come out of the ground. Gasoline is the product of refining crude oil. You take the crude component and then you refine it, and you turn it into things like jet fuel, or you turn it into things like gasoline. The refineries in the northern part of the United States are designed to handle crude that is being shipped in from Canada. The refineries in the southern parts of the United States are designed to handle crude that's being shipped up from the Permian Basin, from West Texas. These two different kinds of crude are different. They're different kinds of oil. Chemically, they are different, which means that the refineries in Michigan and in Minnesota literally cannot process the crude that is pumped in Texas. You would need billions of dollars of retrofitting to be able to process that crude. Not to mention the fact you have to build a whole series of pipelines to figure out how to get that crude from Texas or Oklahoma all the way up to the northern part of the country. It is extraordinarily expensive to rejigger energy supply chains and extraordinarily time consuming. And if we cut Canadian energy out of the American market, we're likely going to see gasoline prices increase by 15 to 20%. There's nothing you can do to fix that quickly. So that's one of the problems, right, when it comes to like more investment in the U.S. The other problem is, of course, like a labor component. There are certain things that we could probably make here in a competitive way. Maybe it is steel, maybe it is aluminum, I'm not sure. But textiles are a great example of something that the emerging world does really, really well. Like, you do not want an American-made pair of jeans unless you're trying to spend $200 on them. You certainly do not want an American-made iPhone unless you're trying to spend $10,000 on it. Like, labor costs here are just way too high to incentivize the production of a lot of these finished goods that we use. So there will likely be some additional investment in the U.S., but I don't think we're going to be able to undo all these different trade linkages that quickly. I think tariffs are going to be quite problematic from a price perspective, and perhaps from a growth perspective. And I have time for one more, Justin, and then I got to roll. I'm sorry.
Yeah, no worries. So last one, pretty simple. What about impact of government layoffs, I guess, with regard to like unemployment?
Yeah, I mean, the federal government employs about 3 million people. That is a big number of people. It is also, maybe 2 or 3% of the overall labor force. There are 150 million people in this country that work, so 3 million is not a huge number. You're not going to see all of them laid off, but if you do see some of them laid off, especially if you see them laid off en masse, that likely will have an impact on consumption. That's 1 million people that all of a sudden don't have a job anymore. Now, the net effect longer term is that if you lay off all these people and you right size the deficit and the interest rates come lower and taxes come lower and spending increases, then maybe you can offset it over the long run. But it would be a pretty nasty one-time hit to the economy if you overnight just laid off 1 million people. There'd be really no way to get around that. But again, over the long run, maybe it all kind of smooths out.
All right, great. Jack, thank you very much. Again, appreciate all the info, appreciate the data. Thank you for taking some questions. That's all we had for today. So if anyone has any questions other than that, or they want to speak about their specific situation, please feel free to reach out to us. We're here. We are obviously keeping our eye on everything that's going on with the markets and the economy during this uncertain time. We're trying to figure it out along with everyone else. So as things change, we'll keep the information out there. We'll keep people up to date, and most importantly, we'll update portfolios as necessary. Thank you for joining us today.
Thank you.